Hello, and welcome to CAP STRAT this week. Let's get into it. Let's start with market performance for the week ended January 12th.
Quick intro. Good work.
I'm trying to cut it down a little bit.
Last week, a lot of cross currents. We're kicking off earnings season, but it was just banks reporting. Stocks opened the year pretty negatively, so a little bit of a rebound. We saw some price appreciation in some of the Magnificent Seven names, Meta, Alphabet, Nvidia, all up for various reasons, but really not a whole lot going on last week. And still, if you look at large caps year to date, pretty much flat.
Right. How about on the fixed income side, a little bit of light green here as well?
On the fixed income side, the big news, you had a lot of Fed speak, and you had two inflation reports, and CPI came out hotter than expected for the first time in a little bit, and in a few months, and that generally sent Treasury yields up. That combined with some Fed speak pushing back on the idea of a rate cut in March, that also put some upward pressure on Treasury bond yields, especially at the short end. But then we got PPI on Friday, and PPI still in deflationary territory, which was a surprise. And if you combine CPI and PPI, you can predict PCE with pretty good accuracy. So towards the end of the week, we got bond yields to come down, and that was me saying a lot to basically just say we had some green on the board. So
we'll take it. And then alternatives, actually a little bit of red here. Anything we want to spell out on the alternative front?
The biggest mover is year-to-date column, still seeing energy up 4.4%, but overall a pretty quiet start to the year, especially given everything that's going on in the world.
Right. So you mentioned, especially on the fixed income side, CPI report from December got released and a lot of Fed speak. So let's dive into that a little bit more, and let's start with why that report is so important. Mm-hmm. The first part being, as you mentioned, first report to come in hotter than expected, certainly since the Immaculate Landing regime started to become priced in. And maybe more importantly, it's the last CPI report before the January FOMC meeting. Mm-hmm. And we believe that at the January FOMC meeting, they will start to try to guide the market more around what they're going to do at the March meeting, which is when the market expects some cuts to start happening. Mm-hmm. So, Mike, walk us through what we've gotten broken down here on the CPI sub-baskets and why this is important and what the Fed could be looking at.
Yeah, we have a little dislocation. If you dissect core CPI into three baskets, you have the light blue line, which is goods, the goods portion of that core basket, down 2.4%. Here we're looking at 6-month change annualized.
Right.
The 6-month change is what everybody's excited about because we have seen such good progress on inflation over the past 6 months. At an annualized rate, the goods basket is really dragging down the overall number. It's down 2.4%, 6-month annualized. And, if you look at the other two baskets, then you have shelter, purple, that's up 5.35% over the 6 months annualized. And then finally, you have services ex shelter, which is going the opposite way of goods right now. It's accelerating, and it's up 5.5%. So in our view, when we look under the hood at core CPI, it reinforces a lot of what we've been talking about for quite some time now, and what's factored into our overall core CPI forecast, which is these cross currents, right? So let's take these baskets sort of one by one. Which ones are more concerning, less concerning? Where are they headed? We'll start off with the good news that you've had out of the goods area of the economy. You've had this big deflation, disinflation impulse since really Q2 for a few reasons. One, consumers shifted their demand from goods fully into services as we got into the back half of 2023. So that definitely helped. And then as we got to the holiday period, a lot of retailers, businesses had inventory that they wanted to get rid of, and they marked it down. They discounted it heavily. We know around holiday shopping, a lot of consumers were taking advantage of steep discounts. So you had that heavy discounting. And then another thing you have going on here is China. China's economic recovery, pretty lackluster. Their exports pretty lackluster, and the yuan pretty weak relative to the dollar. So all of those dynamics happening and hitting the goods basket over the last 6 months. And as you think about each of those factors as we go forward, if consumers' demand sort of normalizes more between goods and services, if retailers, now retail outlets, now that they pushed out that inventory they don't want at a heavy discount, now they start to restock and firm up prices, which they'd like to do to preserve margins. And then you get some type of a recovery in Chinese economic growth, which we know seems far-fetched, but also a lot of the stimulus they've been announcing, it actually isn't really going to hit the books until 2024. You could get a stronger yuan. So that's to say a pretty conservative estimate here is that this light blue line should kick back up to above zero over the next 12 months. If you're on board for thinking the goods sector or the goods portion of core CPI is going to keep deflating at 2.4% in 2024, you're probably thinking a recessionary type outcome, right? Which our recession signal isn't active. So this was helpful. Now we think going forward it's going to be less helpful. PPI number came in negative. So that reinforced that, hey, December was a deflationary month for goods producers, but that might be the last one of those that we get for a little while. So if you're the Fed, you're excited about the blue line coming down, but you might start to get concerned that it could start to come back up.
Right.
And then you take the shelter component, which is obviously running hot, but it's clearly off the highs. And if how the CPI basket tracks things like shelter and rent, it's slow moving, it lags home prices. If you look at various indices that track new rents or market rents, those suggest that this purple line should continue to come down throughout the year. And so the Fed and everybody else in the market is pretty much banking on continued disinflation from the shelter basket. That's sort of in the pipeline, is how they're viewing it. And then the last piece is if you're a Fed voting member, what you're concerned about. That's services inflation. No real progress here, coming up pretty sharply. And that's obviously the most concerning at this stage in the cycle because we know services ex shelter is the most labor intensive part of the economy. And so if you're worried about a wage price spiral, if you're worried about sticky prices, if you're worried about, hey, what if we accidentally cut rates prematurely, this green line going up is keeping you up at night.
Yeah.
Right? So we think it should normalize a little bit. It's sort of the flip side of consumer demand when they all shifted away from goods and into services. All right, well, that puts some upward pressure on services inflation. If that normalizes, hopefully that green line will normalize. But in our view, you look under the hood here, no way there's a cut in January. That's not a hot take.
Yeah.
But we think cuts in the first half of the year are even premature because of this dynamic.
Yeah. And so you noted a premature cut could further invigorate the job market and create more inflation on the services side. The other side of that too, with the purple line is, one of the biggest inputs into home prices is mortgage rates. Mm-hmm. If the Fed cuts rates too soon, mortgage rates fall, home prices go up, all of a sudden you're getting more shelter inflation potentially as well.
Right.
So a couple of risks to be wary of, from a premature cut perspective. We take all of these things in and talk to our inflation forecast. I mean, that's why we're still looking at, right around a 3 handle for core CPI 12 months out.
Yeah, exactly. And that's above consensus. But we think based on these dynamics and where the inflation's coming from and how sticky it typically is, we think it makes a lot of sense. We feel pretty good about that forecast. Also, this is CPI. So the Fed's preferred gauge is PCE, which generally runs below CPI. So it probably puts you in a 2.25% to 2.5% core PCE number by the end of the year, which is above the Fed's target, but it's probably not something that would require more hikes, that's for sure, right? We're really just talking about the pace and the magnitude of cuts. That's one of the primary tools. Because even if core CPI is running at 3, core PCE is running at 2.5, the Fed is still probably in a position where they're thinking, yeah, that's above our target, but there's no reason why in order to get it down to our target, we need to have the Fed funds rate at 5.25 to 5.5. Right? Yeah. That's just too risky. We can still make progress on inflation if we bring the Fed funds rate down to something like 4.5 by the end of the year, which is in line with our forecast.
Right.
Right.
Right. Yeah. So a potential opportunity to have a less extreme tightness of monetary policy.
Yeah.
Right.
Right.
And so, obviously a lot of uncertainty remains, with Fed actions, particularly around the federal funds rate. That's going to get a lot of the headlines, but we've gotten a little bit more guidance around the other policy tool that's been in place, and that's the runoff of the balance sheet.
Yeah.
And that obviously impacts our liquidity forecast significantly. I'm going to talk about what we've been hearing there.
It was a very interesting week from this perspective, because you look under the hood at CPI and you say, all right, we feel good about no cuts in the first half of the year. You hear the Fed speak, they're pushing back on the idea of cuts in March. So liquidity for the next 6 months is pretty much in line with our forecast. But as you think out to the back half of the year, the other thing that happened was Lori Logan, Dallas Fed president, came out and spoke about reducing the pace of the balance sheet runoff, quantitative tightening. And you combine that with, if you go over the December FOMC meeting minutes, they started to talk about the pace of the runoff. So you put these things together, they want to signal pretty far in advance, help prepare the market for a change in pace of quantitative tightening. And this is new news. I mean, this is new information that we didn't have previously. We previously thought, and most folks thought, that quantitative tightening would go on throughout all of 2024. But now we think what the Fed is doing is they're setting up the market to reduce the pace of the runoff, coinciding with the first rate cut, which in our view is going to be in either June or July.
Right.
So as we get to the back half of 2024, if you reduce the pace of the balance sheet runoff and then wrap it up in December, you actually get a pretty notable improvement in our liquidity forecast just in the back half of our forecast horizon, just second half of the year. So it's this very interesting dynamic where in 1 week, everything that came out of inflation and sort of Fed speak was, if anything, going to disappoint markets in the first half of the year. If you're thinking we're going to cut in March, no, that probably is not warranted. But this new information is actually pretty constructive for the back half of the year.
Yeah.
And potentially an opportunity. I mean, this is the biggest sort of 2 week over 2 week or week over week improvement in our liquidity forecast that we've had in quite some time. It's not going to happen until the back half of the year, but it's within our forecast horizon, right?
Right. Yeah. Absolutely. Anything else you want to hit on from a Fed perspective before we get into economic growth?
No.
Let's do it. So economic growth, still expecting a slowdown in 2024. Any changes to our economic growth projections based on recent news?
Not at the moment, but financial conditions have been loosening quite a bit. Things like GDP now have generally been coming in pretty solid. So, if the Fed is cutting in the back half of the year and in the process of ending the balance sheet runoff, there's upside potential for economic growth in the back half of the year, as long as our recession signal doesn't trigger, right?
Right.
And I guess that's the next slide, so I don't need to do it yet. But it's not triggering. It's not active.
Yeah. And you referenced there, financial conditions easing. Like we could find ourselves back in this situation, which would again be disappointing for markets if the market kind of cuts for the Fed, and then the Fed doesn't need to cut and just further disappoints and delays those easing measures. Right?
Yeah.
So, you just noted recession signal remains inactive. Really even a little bit healthier. I mean, anything we want to note here from a market stress or labor market perspective?
If you look at within the labor market, continuing to back away from trigger thresholds, some weakness in heavy truck sales, and the yield curve still heavily inverted, ultimately signaling that cuts are coming within the next 12 to 24 months is why that inversion is happening. But overall, pretty benign. The market stress signal nowhere close to being active. So pretty benign overall, and we'll keep monitoring.
Awesome.
Yeah.
Sounds good. Well, that'll do it for us this week, for CAP STRAT this week. If you have any questions or comments, please feel free to reach out.